Investing in the capital market can be a rewarding endeavor, but it is not a one-size-fits-all activity. Each investor is unique with different goals, risk tolerances, and investment strategies. Understanding the profile of an investor in the capital market is essential for both individual investors and financial advisors. This knowledge helps in crafting personalized investment plans that align with an investor's objectives and circumstances. This script will explore the different types of investors, the factors that define their profiles, and how these profiles influence investment decisions in the capital market. An investor profile is a comprehensive analysis of an individual's or entity's characteristics that influence their investment decisions. It encompasses factors such as financial goals, risk tolerance, time horizon, investment knowledge, and experience. Understanding an investor's profile helps determine the appropriate asset allocation, risk management strategies, and investment products. Key elements of an investor profile. Risk tolerance, the degree to which an investor is willing to accept potential losses in exchange for higher potential returns. Investment goals, the specific objectives an investor hopes to achieve, such as capital preservation, income generation, or capital appreciation. Time horizon, the length of time an investor expects to hold investments before needing to access the funds. Financial situation, an investor's current financial status, including income, expenses, assets, and liabilities. Investment knowledge and experience, the investor's familiarity with financial markets and their ability to make informed decisions. Types of investors in the capital market. Conservative investors prioritize capital preservation and are generally risk-averse. They prefer investments with lower volatility and are willing to accept lower returns in exchange for stability. Conservative investors typically allocate a significant portion of their portfolio to fixed income securities such as bonds, treasury bills, and money market instruments. Risk tolerance low. Investment goals, capital preservation, stable income. Time horizon short to medium term. Common investments, government bonds, blue chip stocks, certificates of deposit CDs, money market funds. Moderate investors strike a balance between risk and reward. They are willing to take on a moderate level of risk in exchange for the potential for higher returns. These investors typically diversify their portfolios across a mix of equities, bonds, and other asset classes to achieve growth while managing risk. Risk tolerance medium. Investment goals, capital appreciation, income generation. Time horizon medium to long term. Common investments, diversified stock portfolios, balanced mutual funds, corporate bonds, dividend-paying stocks. Aggressive investors are willing to take on higher levels of risk in pursuit of higher returns. They are comfortable with market volatility and are often focused on long-term capital appreciation. Aggressive investors may allocate a significant portion of their portfolio to equities, including growth stocks, emerging markets, and speculative investments. Risk tolerance high. Investment goals, long-term capital appreciation. Time horizon long-term. Common investments, growth stocks, small-cap stocks, international equities, alternative investments e.g., private equity, venture capital. Income-focused investors prioritize generating a steady stream of income from their investments, often to fund retirement or supplement their current income. These investors may focus on dividend-paying stocks, bonds, real estate investment trusts, REITs, and other income-generating assets. Risk tolerance varies, typically low to moderate. Investment goals, regular income generation. Time horizon varies, depends on the need for income. Common investments, dividend-paying stocks, bonds, REITs, annuities. Speculative investors are willing to take significant risks in pursuit of extraordinary returns. These investors often focus on short-term gains and may engage in trading strategies such as options, futures, or cryptocurrencies. Speculative investors are typically well-versed in market dynamics and are comfortable with the potential for substantial losses. Risk tolerance very high. Investment goals, short-term profit maximization. Time horizon short-term. Common investments, derivatives, options, futures, cryptocurrencies, penny stocks, leveraged ETFs. Factors influencing investor profiles. Age and life stage. An investor's age and life stage significantly impact their investment profile. Younger investors with longer time horizons may be more willing to take on risk as they have time to recover from market downturns. In contrast, older investors nearing retirement may prioritize capital preservation and income generation. Young investors typically more aggressive, focusing on long-term growth. Midlife investors often moderate, balancing growth and income as they prepare for retirement. Retirees usually conservative, focusing on preserving wealth and generating steady income. Income and financial situation. An investor's current financial situation, including income level, savings, and debt, plays a crucial role in shaping their investment profile. High-income individuals with substantial savings may be more comfortable with taking risks, while those with lower incomes or significant financial obligations may prefer a more conservative approach. Investment knowledge and experience. Investors with more knowledge and experience in the capital markets are often more confident in making investment decisions and may be willing to take on more risk. Conversely, novice investors may prefer simpler, low-risk investments until they gain more familiarity with market dynamics. Psychological factors, such as an investor's temperament and emotional response to market fluctuations, also influence their profile. Some investors are naturally more risk-tolerant and able to stay calm during market volatility, while others may react emotionally and prefer a more stable, conservative portfolio. Investment goals and objectives. Different investors have different goals. Some may prioritize saving for retirement, while others may focus on funding education, buying a home, or generating passive income. An investor's goals directly impact their risk tolerance, asset allocation, and overall investment strategy. Tailoring investment strategies to investor profiles. Asset allocation. The cornerstone of any investment strategy is asset allocation, the process of dividing investments among different asset classes, e.g., stocks, bonds, cash, to balance risk and reward. An investor's profile determines the appropriate asset allocation. For example, a conservative investor might allocate 70% of their portfolio to bonds and 30% to equities, while an aggressive investor might allocate 80% to equities and 20% to bonds. Risk management. Investors need to manage risk according to their profiles. Conservative investors may employ strategies such as diversification and investing in low volatility assets. In contrast, aggressive investors might focus on high-growth stocks and alternative investments but need to be prepared for significant fluctuations in value. Time horizon considerations. The time horizon impacts how much risk an investor can take on. Longer time horizons allow for greater exposure to equities and other high-risk investments, since investors have more time to ride out market volatility. Shorter time horizons require a more conservative approach to ensure that funds are available when needed. Regular portfolio reviews. An investor's profile can change over time due to life events, changes in financial circumstances, or shifts in goals. Regular portfolio reviews are essential to ensure that the investment strategy remains aligned with the investor's evolving profile. Adjustments to asset allocation, risk management strategies, and investment products may be necessary as circumstances change. Financial advisors play a critical role in helping investors understand their risk tolerance and overall profile. Through risk assessment questionnaires and discussions, advisors can gauge an investor's comfort level with market fluctuations and potential losses. This information is used to create a customized investment plan that aligns with the investor's goals and risk tolerance. Based on an investor's profile, financial advisors can craft personalized investment plans that take into account factors such as risk tolerance, time horizon, and financial goals. These plans may include recommendations for asset allocation, specific investment products, and strategies for managing risk. Advisors also have a responsibility to educate investors about the capital markets, investment products, and the risks and rewards associated with different strategies. By providing education and guidance, advisors empower investors to make informed decisions that align with their profiles. As investors' profiles change over time, financial advisors provide ongoing support to ensure that investment strategies remain aligned with their evolving needs. Advisors regularly review portfolios, recommend adjustments, and help investors stay on track to meet their financial goals. Market conditions, particularly during periods of volatility, can test an investor's risk tolerance. For example, a moderate investor may become more conservative after experiencing significant market losses. Conversely, a conservative investor might become more risk-tolerant during a bull market. Understanding how market conditions influence investor profiles is crucial for making timely adjustments to investment strategies. Financial markets are constantly changing, and investors need to be adaptable. Whether facing inflation, interest rate changes, or economic downturns, investors must adjust their strategies to stay aligned with their profiles. This might involve rebalancing portfolios, shifting to more defensive assets, or taking advantage of opportunities in emerging sectors. The profile of an investor in the capital market is a multifaceted concept that encompasses risk tolerance, financial goals, time horizon, and personal circumstances. Understanding these factors is essential for making informed investment decisions and crafting personalized strategies that align with individual needs. Investors are not a homogeneous group. Each person's profile is unique, shaped by their life stage, financial situation, and psychological makeup. By recognizing the diversity of investor profiles and tailoring investment strategies accordingly, both individual investors and financial advisors can maximize the potential for achieving financial success while managing risk effectively. In the end, the key to successful investing lies in self-awareness and the ability to adapt strategies to changing circumstances. Whether conservative, moderate, or aggressive, every investor can find a path to financial security by staying true to their profile and making informed decisions in the capital market.